The collar strategy to speculate in stock markets. A collar strategy involves holding the underlying stock, buying a protective put, and selling a covered call. It's a way to protect against large losses, but also caps potential gains. What is the strategic goal of the collar strategy in stock options? The strategic goal of the collar strategy in stock options trading is balancing risk management with capped gains. This strategy involves holding the underlying asset, buying a put option to protect against downside risk, and selling a call option to offset the put's cost. It aims to provide downside protection while accepting a limit on the upside potential. The primary goal of a collar strategy is to protect stock investments from significant losses while capping potential gains. This is achieved by holding the underlying stock, buying a protective put option to limit downside risk, and selling a covered call option to offset the cost of the put, which in turn caps the upside potential. The strategy is primarily focused on hedging against market movements and preserving capital, rather than aggressive capital appreciation or income generation. How does the collar strategy adapt to changing market conditions? The collar strategy is suitable for moderately bullish or stable markets. It works well when modest price increases are expected. However, large gains are capped due to the sold call. In bearish markets, the put option provides protection, limiting the potential loss. A collar strategy is most effective in moderately bullish or stable market conditions. It is designed to provide downside protection in uncertain or slightly bearish markets while allowing for some capital appreciation. This strategy is less beneficial in strongly bullish markets, as the sold call option limits the potential upside. What is the risk profile for a collar strategy? The risk profile for a collar strategy involves limited downside with capped upside potential. The strategy ensures that losses do not exceed a certain level. It's set by the put strike price, but it also means that any gains beyond the call strike price will not benefit the investor. The collar strategy limits downside risk to the strike price of the protective put, minus the cost of the put and any gains from the call premium. The primary risk is that the stock's price increases significantly and the stock is called away due to the covered call, capping the potential gains. The investor's risk is balanced between the protection from the put and the limit on gains by the call. What are the potential rewards of using a collar? The potential rewards of using a collar include limited gains with downside protection. While the strategy limits the maximum profit that can be achieved due to the price paid for the call option, it provides a safety net against significant losses, making it a conservative strategy. The reward potential of a collar strategy is capped at the strike price of the covered call option. The best case scenario is the stock price increasing up to the call's strike price, allowing the investor to realize moderate gains while having downside protection. The cost of the put is often offset by the income from selling the call, but the overall profit potential is limited. What are the considerations for implementing a collar strategy in stock options trading? Key considerations for implementing a collar strategy include selecting appropriate strike prices and expiration dates for both the put and call options, ensuring they align with the investor's market expectations and risk tolerance. The strategy requires careful balancing of the cost of the put option with the income from the call option. Continuous monitoring of the stock and options prices is essential to adjust the strategy as market conditions change. Implementing a collar strategy involves holding shares of the underlying stock that the investor seeks to protect. Buying a put option to set a floor for potential losses. The strike price of the put is typically at or below the current stock price. Selling a call option with a strike price above the current stock price, generating premium income that can offset the cost of the put. Choosing expiration dates that align with the investor's market outlook and risk tolerance. Monitoring the stock price and being aware of assignment risk on the call, especially if the stock price approaches or exceeds the call's strike price. Understanding the trade-offs between the cost of downside protection and the cap on potential gains. A collar strategy in stock investing is a conservative approach that balances downside protection with capped upside potential. It is particularly suitable for investors who are willing to forego some profit potential in exchange for reduced risk and greater peace of mind in uncertain or moderately bullish market conditions.